Hello everyone, it is a pleasure to be here today and I would like to extend my thanks to the event organizers on behalf of Aboissa. Today, we will go beyond the numbers to uncover the true dynamics of Brazilian oleochemical market. As we all know, Brazilian is a global powerhouse in the commodity sectors, but the most fascinating story is not found in the volume, but in the complexity and the opportunities hidden within. To navigate this landscape and succeed, we must first understand the driving forces that define the pulse of this market. Today, Brazil has approximately 25 oleochemical industries located mainly in the industrial parks of the country's southern and southeastern region. Looking at the numbers, Brazil stands out for its size and most importantly for the diversity of its internal demand. According to consolidated data from market reports by consultancies like Granville Research, the Brazilian oleochemical market is projected to exceed $680 million by 2030, with a compound annual growth rate of 6.1%. And what truly drives these numbers? It is not just one factor. When we analyze the growth drivers of the Brazilian market, we see the action of two distinct but completely deeply interconnected forces. On one hand, we have what I call qualitative demand, and it comes from sectors like personal care, cosmetics, and food, which increasingly demand high quality products. On the other hand, we have the consumer demand, driven by the end consumer search for ingredients that are increasingly aligned with ESG norms and values that it is from renewable sources, with traceability and a green appeal. This is a constant, high value-added force that pulls the industry quality upward, requiring specialties such as fractionated fatty acids and high-purity glycerin. However, and this is the key to understanding Brazil, this qualitative demand does not operate freely. It acts upon a scenario where the dynamics of price and availability are defined by a much larger force, or major trend in raw materials consumptions, that is the biofuel policy. And this is where the Brazilian dynamics becomes quite unique. The biodiesel mandate, which is now advancing to B15, acts as an immense vacuum cleaner for these raw materials. It competes directly for the same soybean oil and bovine tallow that the oleochemical industry needs to manufacture its products. In practice, this means that the cost of these raw materials for a bar of soap or a fabric softener is not defined merely by the harvest or the demand for cosmetics, but by the governmental decisions on the energy matrix. This policy, while ensuring a gigantic production base, inflates the cost of inputs of other sectors. And the most direct consequence of this in the numbers, when we look at the projections, it is no coincidence that the fatty acid methyl esters, the FAME segment, is the one with the most accelerated growth. It is not just a segment of the market, it is the segment that shapes the market. It dictates the price, the volume, and, as we will see later, generates the co-products that will create other challenges and opportunity. And this massive influence of biodiesel on the entire production chain forces us to look with a magnifying glass at the true beating heart of Brazilian market, where this whole dynamic begins. This brings us to the deeper discussions of the sectors of raw materials. When we talk about raw materials in the Brazilian oleochemical market, there are two absolute protagonists that define the supply chain dynamics. Unlike in Asia, where the palm oil is the main market driver, in South America, the primary inputs for oleochemical production are soybean oil and bovine tallow, offering both plant and animal-based product. But what I want to discuss today, it is not their obvious importance, but rather how the battlefield for these inputs have been reconfigured in the recent years. Before commenting on soybean oil and the bovine tallow, I would like to first start by explaining why palm and palm kernel oil are not as commonly used in Brazil oleochemical. Although Brazil has a large annual production of around 600,000 tons of palm oil and the domestic consumption is at 1.2 million tons per year, it creates an inherent dependence on both the oil and its derivatives, which are used mainly in the sectors like food, hygiene, and cleaning. Furthermore, national production is geographically concentrated in the north region of the country, mainly in the state of Pará. For an industry that are located in the southeast, the logistical challenge is immense, and inland freight in Brazil tends to be very expensive. Considering we live in a country of continental dimensions with road transport being our primary model, often the cost of transporting palm oil from the north of Brazil is higher than importing it from Colombia or other neighbor countries. This, added to the reality we faced last year with the impacts of El Niño, which reduced the yield of the palm fruit by 48%, led to an unprecedented shortage in the Brazilian market. Contract breaches were numerous and the market remains fragile still today, with improvements being expected only by September of this year. Moving on to soybean oil, Brazil is a powerhouse, as we all know. To put it into perspective, Brazil, as the world's largest producers, harvests a soybean crop of around 150 million tons. Of this total, a significant portion, about 55 million tons, is crushed domestically and the rest is exported. This crushing generates approximately 11 million tons of soybean oil, and of these 11 million tons, domestic consumptions absorb the majority of it, almost 90% of the production. And the largest destination for this oil is not for the food industry, but for the biodiesel, which alone demands between 8 and 9 million tons per year to meet the mandate. With an expected increase, given that the biodiesel blend was raised to 15% last week, this leaves a much smaller volume for export, typically between 1 and 2 million tons, and practically insignificant amount for import. The strategic question here is, for whom is this oil available? As we've seen, the biodiesel mandate acts as the main driver of demand, kidnapping a huge portion of supply for the energy sector. These create direct and fierce competition. For a player in the oleochemical industry, this means operating in a market of volatile premiums. A supplier's decision to crush the grain doesn't just depend on the price of the Chicago Board of Trade, but on the arbitrage between three main markets. One being the export market for crude oil, the domestic biodiesel market with its specific auctions and rules, and finally, for our market, the oleochemical and food, which often needs to pay the highest premium to guarantee their supply. And what does this mean in practice for the oleochemical industry? It means we are not competing for a slice of 11 million tons. In reality, we are competing for what is left over. Our industry disputes a portion of the volume that remains after the energy sector, with its massive and regulated demand, has already been served. This put us in a position of being the price takers, extremely sensitive to any variation in the biodiesel mandate or the premium paid by the sector. Now let's talk about the bovine tallow, which is perhaps the raw material that has undergone the most radical transformation in these past years. Historically, tallow was seen as a low-cost co-product, a cheap alternative to the soybean oil. That reality no longer exists. Today, tallow is a mainstream raw material considered a low-carbon product, and at various times in 2023 and 2024, it traded at a significant premium over the soybean oil. And why? For two main reasons. First, the same pressure from biodiesel, which also utilizes But the second and more impactful is the global demand for SAF, the Sustainable Aviation Fuel. The strong demand from the United States for tallow for the production of this biofuel and aviation biokerosene has created a new and voracious competitor. Our hygiene and cleaning and oleochemical industries no longer compete only locally for raw material. We compete with the California's decarbonization policy. For 2025, the North American market remains a strong consumer of the Brazilian tallow. However, everything indicates that this will no longer be the case for 2026. On the last week, the Trump administration vetoed an incentive for credits used for the imported raw materials. The termination of these benefits will drastically reduce the competitiveness of imported raw materials for American biodiesel production, and therefore for the Brazilian tallow as well. This graph shows Brazil's tallow exports for 2023, 2024 and the projections for 2025 at 250, 320 and 400,000 tons respectively. Just in the last month, Brazil exported 75,000 tons of tallow to the United States, and with the reduction in the US consumption for 2026, Brazilian players will need to divert a large part of this volume to the new destinations or the domestic market, which could become a great opportunity for the Brazilian oleochemical to operate with greater competitiveness. Additionally, we see an important window for Chinese SAF, given that all major tallow exporters in Brazil have long-term contracts with the storage tanks at the Port of Santos, thus require high export volumes. To conclude, and based on what we have analyzed today, I would like to make a few brief comments on the trends that point to the new opportunities in the Brazilian oleochemical sector. First, the evolution of demand is notable. The Brazilian consumer has a growing interest in natural cosmetics, which open up space for the development of bioactives, many with the unique potential of our biodiversity, such as Amazonian oils and babaçu. These same trends of seeking alternatives to petroleum derivatives is expanding to the industrial sector. We see a consistent movement towards the replacement of petrochemical products, creating a growing market for items like biolubricants and plant-based biosolvents. In parallel, our own value chain is becoming more sophisticated. The large volumes of co-products from the biodiesel industry, such as glycerin and fatty acids, are increasingly being seen as a strategic platform for the development of higher value-added chemical specialties. Finally, a fundamental point is the consolidation of sustainability as a pillar of business. The pursuit of chain of custody certifications and other ESG practices is not only about regulatory compliance, but also about positioning Brazil as a reliable supplier of plant-based oleochemicals for the demanding markets of Europe and Asia. These movements taken together indicate a market in full maturation, with a clear potential for sophistication and value addition in the coming years. On that note, I would like also to give a brief overview of the glycerin market in Brazil before passing the word to my colleague Arthur, who will delve deeper into the topic of biofuels. In recent months, especially between May and June 2025, we observed a rise in the spot prices for crude and refined glycerin, with heated demand particularly for refined products. This movement is part of a trend we have been observing in the glycerin market, where buyers have an almost bi-monthly appetite for restocking, oscillating between months of high demand followed by more balanced ones. In any case, the current situation of the refined glycerin market is undoubtedly heated, with high demand for the refined product both domestically and internationally, which is precisely what is causing the price hike we have seen since the last year. Currently, the FOB Santos price for refined glycerin is varying between $900 and $1,000 per ton, with prices expected to remain stable. However, we are talking about availability only for September onwards. The suppliers we work with, the largest ones, are already well positioned in the market for their July and August volumes. Brazil has been consolidating its position as an important global player in glycerin exports. We had a very promising year in 2024, with total exports reaching over 700,000 tons, a significant increase of 27.3% compared to 2023, which places us at a new level with the prospects for this year. In January 2025, we hit an export record reaching 77.4 thousand tons, with China absorbing the largest share, about 72% of this volume. However, on February 2025, we saw a significant drop, with exports falling by more than 21% compared to January to 60.9 thousand tons, and China reducing its purchases. In contrast, the prices of glycerin increased exponentially during this period, as can be seen in the graph, going from $290 per ton CIF China in January to last week, where volumes are already being negotiated for September at $575 per ton. With the B15 mandate, the availability of crude glycerin in Brazil is expected to increase. However, the eagerness to add value to this co-product is also great. Still in 2025, 2 new refineries are set to open, which at full operation will add 5,000 tons of refined glycerin monthly to the Brazilian markets. However, these same plants are already entering the market as buyers of crude glycerin, their main raw material. It is still too early to make a more assertive analysis of this market, but it becomes even clearer how Brazil's energy policies are highly interconnected with its oleochemical market.
Hello everyone, I'll now present a straightforward overview of how the biofuels sector is performing in Brazil and globally, with a focus on the impacts on raw materials such as vegetable oils and second-generation feedstocks like tallow, TCO and acid oils. So, the Brazilian government has confirmed the adoption of the B15, the country's new biodiesel mandate, which will be effective from August. B15 had been delayed but was finally approved, and this will boost the soybean crushing by about 750,000 tons between September and December, and is expected to generate 600,000 tons of soybean meal and over 300 million liters of biodiesel, totaling almost 10 billion liters in 2025, according to industry estimates. It will also increase the demand for soybean oil by 150,000 tons. But the major issue, besides the delay, is the non-compliance with the mandates by the producers, a recurring problem in recent months. However, the industry is organizing to improve the enforcement in this business. With the blend increase, the projections estimate a plus 0.36 GDP growth per month, a 2.35 rise in the soybean oil production, and a 1.37 increase in the poultry production. Also, the inflation is expected to fall and the protein prices may stabilize, all while reducing dependence on imported diesel, lowering logistics and production costs. Although B15 has been implemented, the contracted volume for the last 4 months period was 1.65 million cubic meters, 23% above the minimum target, yet still insufficient to fully meet the new mandate. This highlights a lack of coordination between target and market execution. In addition, Brazil increased its ethanol blend in gasoline to E30. Together, this mandate stimulates the byproduct market. More biodiesel leads to more oil, which leads to more soap stock, which is the raw material used to produce the soapstock acid oil, while the ethanol results in the technical corn oil as a byproduct. Also worth noting, the renewable fuels accounted for 25.7% of the energy used in the transportation in Brazil in 2024, a significant increase. Due to delays and non-compliance with the B15, the oil demand has lost momentum as well, while the US and China trade dispute boosted the grain demand, driving up the exports. In May, Brazil shipped 165,000 tons of soybean oil, up 66% from April forecasts, pointing to 1.4 million tons for 2025, helping to absorb surpluses and stabilize margins. Finally, Brazil's biodiesel demand in 2025 is estimated at 9.6 billion liters, a 6% increase over the last year. Furthermore, the mandate to use UCO and residual oils and fats, a policy created to encourage these renewable commodities in Brazil, was postponed for 6 months. In 2023, only 1% of the biodiesel came from used cooking oil, and 755,000 cubic meters, or 8%, were produced from various animal sources, such as beef tallow, which is the mostly. The use of these feedstocks is expected to grow significantly in Brazil, but for now, the US continues to demand large volumes of animal fat, while the European Union offers double counting and favors second-generation feedstocks. In Brazil, Petrobras is authorized to sell marine bunker fuel with up to 24% biodiesel blend. Other domestic producers are eyeing this as a promising market. Meanwhile, Argentina has authorized the use of pure blended biodiesel in vessels, a crucial step forward the IMO's zero-emission target by 2050. With compatible engines and ISO standards, South America is moving forward in the new low-carbon bunkering market. But also in Argentina, only 24% of the projected 49 million metric tons of soybean from the 2024 and 2025 crop had been sold, the slowest sales pace in the last 11 years. In the US, the soybean futures are rising on the Chicago Board of Trade, driven by higher vegetable oil prices following the Senate approval of a tax bill proposed by the White House. The bill extends the tax credit for low-carbon biofuels like biodiesel. The bill extends tax credits for low-carbon biofuels like biodiesel, incentivizing the use of US-produced agricultural feedstocks and reducing the benefits for foreign raw materials, which should cut international UCO imports. The program has been extended until 2029. Also, now on the international side, Malaysia produced 300,000 cubic meters of biodiesel in the Q1, according to data from Kuala Lumpur. The 18 active plants in the country put 300,000 cubic meters on the market in the first 3 months, about 12% less than the same period in the last year. The year 2024 had already been challenging for the industry, which closed at 1.2 million cubic meters and in a 4-year growth streak, and using only 48% of the installed capacity. Also, Turkey is expected to soon announce a new SAF mandate, Russia's sunflower seed harvest is expected to hit a record level, and the UK had defined its liquid zero-carbon maritime transport strategy for 2050. Now for the closing remarks. Brazil is strengthening its role as a global player in the biofuel sector by expanding the domestic demand, increasing the blending mandates, and introducing regulatory updates that incentivize the production and the use of diverse feedstocks. The feedstock diversification is accelerating, with greater use of second-generation inputs such as tallow, acid oil, and technical corn oil, alongside with traditional vegetable oils. This opens new avenues for the producers and exporters of low carbon intensity materials. Also, Argentina and other South American countries are gaining traction as reliable suppliers of feedstocks, particularly due to their strong agricultural base and growing participation in the global renewable fuel supply chains. In summary, Latin America, led by Brazil and Argentina, is well positioned in the supply both the traditional and advanced biofuels market, contributing to the decarbonization of the transport and strengthening the global energy security. Thanks a lot for the opportunity, and if you'd like to know more about the oleochemical market or the biofuels market, please contact us by this QR code. Thank you.